Thank you for joining us today. I realise it's a busy time for you all, and I appreciate that you've set aside the time to hear this talk. So as Jackie said, my name is Rachael Fitzpatrick, and before diving in, I thought I'd just quickly share a bit about myself. So what do I do at the RBA? Well, I work in the Economic Analysis Department in the Asian and International Macroeconomics team. The role of this team is to provide the RBA board with analysis and forecasts of economic activity in Australia's major trading partners. So this can involve working with data, keeping across news of relevant developments, and monitoring other central banks' updates on their economies. I've been at the RBA for around 6 years, and I've had the opportunity to work in a number of other areas, including on the regulation of payment systems and in the area responsible for analysing commercial banks' lending activities. I also spent a couple of years working in the UK at their central bank as well. Like yourselves, I actually started studying economics at high school. And one thing that really grabbed me about it was the way that it provided what I thought was a really useful framework for asking and answering interesting questions about all kinds of things that I could see going on around me or being discussed in the news. For example, how society interacts with the environment, changes to regulation or taxes, and of course that thing I and probably you have heard referred to as the state of the economy, which we're going to spend some time on today. I enjoyed it so much that I decided I wanted to study it at university. I don't think my parents quite knew what to make of this though, because at that point we didn't know any economists, and I think they worried that I might not get a job. So I took my dad along to a talk at a university open day about their economics program and where it can take you. One point they made, which I think reassured my dad, was that there's actually quite a few career paths and industries where training in economics is really valued. It's just that economist isn't always the job title. In fact, most of my internships through uni and jobs in my career since then, with the exception of my current one, didn't have a job title of economist, but it was my training in economics that I was using to get the job done. So I think it's really great that you were all studying economics, and even if you don't go on to study it at uni or pursue a career in it, I hope it'll give you some really useful tools for understanding and engaging with some of the really important issues facing society today. So on that note, let's get started. First, I'm going to talk a little bit about the functions of the RBA. Then I'll briefly review how monetary policy works before giving a summary of current economic conditions and how the Reserve Bank has responded. So, what does the RBA do? It's mainly known for its monetary policy decisions and its operations in financial markets to implement these. This is going to be the focus of the presentation today. But the RBA actually does a lot more than this. For instance, we design and print Australia's banknotes. We oversee the payment system to ensure that payments are safe, efficient, and competitive. And one example of this is that the RBA has worked with the commercial banks to have some new infrastructure built so transfers of money can happen almost instantaneously instead of taking a few days like they used to. We're also the Australian government's banker. For example, when the government made JobKeeper payments, the RBA processed those. We process over 300 million payments on behalf of government agencies each year. The RBA, along with a few other government agencies, also has responsibility to maintain the stability of the financial system. So we have a financial stability department that's constantly scanning the Australian and global financial system, particularly banks, for emerging risks. So what guides how the RBA goes about these activities? Well, the RBA is not a commercial bank. It's wholly owned by the government. And whereas a typical bank tries to maximise profits for shareholders, the RBA's objectives are set out in legislation, and they are to ensure three things. First, the stability of the currency, which means that the value of money, so what you can purchase with it, doesn't change too much or too quickly over time. Inflation is a measure of this. Second, full employment. This means that the economy can provide enough work for all Australians that choose to have a job and are qualified and available to work. This doesn't mean that unemployment will be zero though. There are some types of unemployment that monetary policy can't influence. For example, the unemployment that occurs when people move between jobs or aren't qualified for the jobs that need filling. And the third objective of monetary policy is the economic prosperity and welfare of the Australian people. This ties back to the two other objectives we just spoke about, because if inflation is low and stable, and everyone who wants to work is doing so, then people are generally better off. When the Reserve Bank Board sets monetary policy, it strives to meet these objectives. Until recently, this mainly involved setting a target for Australia's official interest rate, called the cash rate. But more recently, it has involved using a wider range of monetary policy tools to support the Australian economy as it recovers from the economic effects of the COVID-19 pandemic. So let's talk about how the RBA sets monetary policy in practice then. The primary way the RBA seeks to meet its objectives is by achieving an inflation target of 2 to 3% per year on average over the medium term. Inflation is simply the increase in prices of things that you and I spend money on, like food, clothing, entertainment, could be transport, childcare, health, and even housing. If inflation rises too quickly, it makes it difficult for businesses and households to make their saving and investment decisions. And if inflation rises by more than households' incomes, then they're going to be worse off because they can buy less goods and services than they were able to before. The RBA doesn't try to always keep inflation between 2 to 3%, as illustrated on this chart here. Inflation is sometimes above and sometimes below the inflation target, and that's okay. But over the medium term, we want inflation to average between 2 and 3%. How do we influence inflation? This graph shows it a bit very simply. The straight line represents potential economic output. It's how we think the economy could perform if all resources are used at their normal levels. You can think of this like a speed limit for the economy. When the economy is growing faster than the speed limit, it's not sustainable. There's too much demand for goods and services, and this pushes up prices. That is, inflation rises. If inflation looks like it will not be consistent with the RBA target, the RBA will want to slow down the economy back to a normal speed. What would the RBA do if the economy is running above its potential and inflation is too high? Well, it would tighten monetary policy to increase interest rates. On the other hand, when the economy is below its potential or growing slower than its speed limit, as it is now because of the economic damage caused by the COVID-19 pandemic, the RBA will want to give the economy a boost to prevent unemployment rising and to increase inflation. In this instance, the RBA will want to loosen monetary policy to decrease interest rates. How does this work in practice? As I mentioned earlier, the main way the RBA board sets monetary policy is through a target for Australia's official interest rate, the cash rate. The RBA can also use other monetary policy tools to influence interest rates, which it may want to do when the cash rate is very low and cannot be lowered much further, like now. We'll discuss some of these later on. The cash rate and the interest rates affected by the RBA's other monetary policy tools are a reference point for other interest rates in the economy, like what people pay to borrow for a house and receive from their deposits held in bank accounts. As a result, changes in monetary policy tend to flow through to changes in these interest rates. Changes in these interest rates affect total spending in the economy and therefore economic growth, employment, and inflation. Let's consider the case where the RBA lowers interest rates. In this case, people don't get as much interest from saving their money, so they're more likely to spend it. It becomes cheaper for businesses to borrow to invest, like for buying better equipment, for example. And loan repayments, for example on house mortgages, become smaller, which gives people more money to spend. There are some other ways, but you get the idea. The boost to spending increases aggregate demand, leading to high economic growth, more employment, and ultimately higher inflation. The challenge for the RBA is that these things happen slowly. Households and businesses don't change their behaviour overnight. In fact, the effect of changes in interest rates might not completely flow through to the economy for up to 1 to 2 years. So often the RBA has to be forward-looking and make forecasts about how the economy will be performing in the future. As you might imagine, the global pandemic and the most recent Delta outbreak in Australia has brought about changes to a lot of things in our lives and the economy too. People, businesses, governments, and central banks around the world have had to adapt and respond to sometimes rapidly changing circumstances. I think this makes it a really historic and interesting time to be studying economics. So good choice. With all of that in mind, now let's take a look at the state of the economy. The spread of COVID-19 and our response to this health crisis has played a big role in the performance of the global economy and continues to influence the near-term outlook. This chart shows the number of new COVID-19 cases each day relative to population size in different countries and regions around the world. Notice that the scales on the top panel are much larger than on the bottom. This chart highlights that success in containing the virus has been quite uneven, with many countries experiencing more than one wave of infections. Most recently, the spread of the Delta variant has driven new outbreaks in a number of countries that had previously been successful at largely suppressing the virus, including Japan, Vietnam, and here in Australia as well, where we're grappling with renewed community transmission. However, some countries are on their way to reducing the effect of COVID-19 as they roll out their vaccination programs. This chart shows the share of total population that is fully vaccinated against COVID-19 in selected countries. In the top panel, you can see that countries like the United States and the United Kingdom, where COVID-19 cases had been high in 2020 and early this year, now have more than half of their population fully vaccinated. This high vaccination coverage has also meant that even as cases have increased once more, the rise in hospitalizations and deaths in these countries has been much smaller, and the containment measures used have been less severe than during the first wave of the pandemic. Australia is catching up with around 30% of our total population now fully vaccinated. This is equivalent to around 40% of the population aged 16 and older, which is the measure you'll tend to hear in our local news. But in most emerging market economies, the vaccination coverage there still remains low, largely a result of limited vaccine supplies so far. As a result of ongoing health concerns, international travel continues to be highly restricted around the world, and our international borders here are closed. This has pretty much removed our ability to travel overseas, or perhaps more importantly, the ability of those overseas to come to Australia. This chart shows short-term visitor arrivals to Australia, so those that stay for less than 1 year. They're split by the purpose of their visit, and it's worth noting the scales are quite different on the left and the right-hand side. You can see that arrivals fell very sharply to zero when we closed our borders at the start of the pandemic and have stayed low since. The RBA's current assumption is that the international border will open gradually from the middle of 2022, so these arrivals aren't expected to recover anytime soon. In addition to the short-term visitors on this chart, the pandemic has also reduced longer-term arrivals, such as migrants. This is expected to weigh on the growth in our population for some time, and so will also affect the ability of our economy to grow. The pandemic has also affected many parts of our lives here in Australia too. In particular, distancing and lockdowns have restricted our ability to go about daily activities like we used to. This chart shows data from Google tracking how much people have been moving around in different parts of Australia, for example, to go to work, shopping, or recreation. In this way, mobility can be a timely indicator of economic activity. In this chart, it's shown relative to pre-pandemic levels at the beginning of 2020. You can see how people really reduced their movement in April last year, and that this largely recovered in much of the country as the virus was suppressed. But movement remained very sensitive to health outcomes, as you can see by the decline in Victoria later in 2020, when they experienced a second large outbreak and further lockdowns. Even outside Victoria, more detailed versions of these data show that some activities never returned to their pre-pandemic levels. For example, use of public transport. This speaks to an important feature of our behaviour, which is that the reduction in mobility you can see here is not just forced by government restrictions, but also reflects precautionary behaviour by people, for example, choosing to stay home more to reduce the risk of catching COVID-19. As large portions of the population have been placed under lockdowns over recent months, you can see here that mobility has again fallen sharply in affected areas. Changes in our behaviour and the movement of people in and out of the country resulted in a very large fall in economic activity in the first half of 2020. This chart shows the change in gross domestic product, or GDP. The bars show the change from the previous quarter, and the line shows the change over the past year. You can see that GDP fell very sharply in the June quarter of 2020, around 7%. We think this is the largest quarterly decline in GDP since World War II. The economy then rebounded as our control of the virus improved, restrictions eased, and people's incomes were supported by expansionary fiscal and monetary policy. This happened earlier and with more momentum than had been anticipated when the pandemic first broke out. However, at its most recent meeting, the Reserve Bank Board noted that it now expects the economy to shrink materially in the September quarter this year because of the Delta outbreak and associated restrictions on activity. This setback is thought to be only temporary, though, with the Delta outbreak delaying rather than derailing the recovery in economic activity. As vaccination rates increase further and restrictions are eased, the economy should bounce back. In the board's central scenario, the economy is expected to be growing again in the December quarter and is to be back around its pre-Delta path in the second half of next year. There is, however, uncertainty about the timing and pace of this rebound in economic activity, and the board has noted that it's likely to be slower than earlier this year. Much is going to depend on the health situation and the easing of restrictions on activity. This chart shows an estimate of the share of Australia's population subject to lockdowns. It reflects recent announcements, but of course the duration and intensity of lockdowns are uncertain and are going to depend on vaccination rates. You can see that it's a mixed picture. The resurgence of community transmission of COVID-19 has seen strict containment measures and border restrictions reintroduced in several states and territories, with people greatly reducing their movement in places like New South Wales and Victoria, as you may recall from that earlier chart. At the same time, the Governor noted in recent parliamentary testimony, when assessing the impact of lockdowns on the economy, it is important not to lose sight of the fact that not all of Australia is affected. Some parts of the Australian economy are still on the positive trajectory that was in place before the recent outbreaks. This is quite different from the first half of last year when the whole of Australia was in lockdown. As we think about the future, it's also worth noting that fiscal policy is again directly supporting households and businesses in affected areas, and that prior to the Delta outbreak, the Australian economy was in a strong position. The national accounts for the June quarter published earlier this month give us a sense of this, so let's take a look at what some of these data had to show us about the Australian economy in a little more detail. The biggest component of GDP is the household sector, consumption, which accounts for around half of Australia's economic activity. On the top panel of this chart is the level of consumption in blue and the level of disposable income, so that's the income available for spending, in purple. The difference between how much people have available to spend and how much they have available to spend and how much they actually spend is savings. And this is shown on the bottom panel of the chart as a share of disposable income. You can see that total consumption contracted sharply at the start of the pandemic when a lot of opportunities to spend were restricted. But this masks some very different spending patterns on different things. For example, spending on international and interstate travel was constrained, like we discussed earlier, as were activities like dining out or attending live shows. At the same time, some categories of spending actually increased, like on groceries and items for the home. As opportunities to spend on discretionary services like dining out become available again, consumption recovered rapidly. And in the June quarter this year, total consumption was effectively back at its pre-pandemic level. A significant boost to household disposable income from government transfers through 2020 has helped to support this recovery in spending. You can see that in the bump up in the purple line. Examples include JobKeeper payments made to businesses to help cover wages and expanded social assistance payments like the coronavirus supplement. These temporary measures had mostly been unwound over the first half of this year though, and so income declined very slightly in the June quarter. The initial fall in consumption and increase to income led to a large increase in the savings ratio, and households have accumulated large savings buffers. The savings ratio has since declined though as consumption has recovered. From all of this, you can see that indicators of household consumption were strong prior to the most recent lockdowns. But over the September quarter, there is likely to be some repeat of the patterns that we saw earlier in the pandemic. Household consumption is expected to decline and the savings ratio to increase in the near term, reflecting limited opportunities for households to spend because of lockdowns. Assuming no further extended lockdowns, consumption should start to recover across the end of this year and the first quarter of next year. What about businesses? This chart shows the volume of business investment by mining and non-mining firms. You can see that before the latest lockdown, non-mining business investment had also recovered more quickly than expected after falling sharply at the onset of the pandemic. This rebound's been supported by strong growth in investment by non-mining firms in machinery and equipment, as they responded to the Australian government's investment tax incentives, the rapid recovery in domestic activity, and strong profits growths in some sectors over the past year. Non-residential construction investment had also started to pick up in the June quarter. These developments are important because, as the Governor explained in a recent speech, a durable recovery from the pandemic requires a strong and sustained pickup in investment. This will help build the capital stock needed to support future production and to support a more productive workforce. The recent lockdowns and temporary restrictions on construction activity in some states are expected to weigh on investment in the September quarter, but a rebound is anticipated after restrictions ease. So if that's how households and businesses have responded so far, what about the labour market? Well, the pandemic also resulted in a very large increase in unemployment and underemployment from April through to July in 2020. This chart shows the unemployment and underemployment rates. These two ratios capture spare capacity in labour market. Spare capacity measures how many people are not working at all or as much as they'd like to be and are actively looking for more work. Like for the activity measures we've looked at, the recovery in the labour market since July 2020 has been faster than earlier expected, driven by the broader recovery in activity. As of June this year, the number of employed people was actually higher than before the pandemic. Accordingly, both the underemployment and unemployment rates were below their pre-pandemic levels. The sustained strength in the labour market conditions had also encouraged more people to seek employment, and labour force participation had increased above pre-pandemic levels for all age cohorts. But it's worth acknowledging that while employment in June was higher than its pre-pandemic level in most industries, it hadn't fully recovered in areas of the economy that continue to be most affected by COVID restrictions, such as in hospitality, air travel, and education. The renewed outbreaks of the virus and associated lockdowns in recent months also means that there's likely to be some reversal of labour market improvements in the near term. For example, the number of people working 0 hours is likely to increase because they've been stood down. We also expect some job losses and for the unemployment rate to increase. Again, though, once vaccinations increase and restrictions are relaxed, the labour market is expected to recover quickly. For now, though, the fall in activity and the extra spare capacity in the labour market has meant that inflationary pressures are subdued. This chart shows changes in headline consumer price inflation. The line shows the change over the past year, and the bars show the change from the previous quarter. The pandemic saw some large temporary movements in prices. For example, policies like free childcare, a sharp fall in fuel prices, rent reductions, and supply disruptions affecting prices of some goods and services. These have now unwound for the most part and resulted in a temporary spike in inflation in June. The removal of subsidies for childcare and after-school care also played into this. As such, inflation has temporarily moved above the bank's 2 to 3% target. However, underlying inflation pressures remain weak, and inflation is expected to be below the target band for some time. This corresponds with the low wages growth we are currently observing, which is an important driver of inflation. The Governor has said that for inflation to be sustainably within the RBA's target band, wages growth needs to be materially higher. So, with that in mind, how has the RBA responded to the largest economic contraction since World War II? If we think back to this diagram shown earlier, given all that you've heard, how do you think the Australian economy was affected by COVID-19? As we saw just a few moments ago, COVID-19 resulted in a fall in economic activity and inflation. Unemployment and underemployment also both increased, which places us here. Therefore, the RBA had a responsibility to act. So what did the RBA do? Well, like central banks around the world, the RBA cut its policy rate, which is the cash rate target. But compared to the past, things have happened a little differently this time around. This chart shows the cash rate target since the early 1990s. You can see how the cash rate target was moved up and down at different times to speed up or slow down the economy. For example, in response to the global financial crisis in 2008, you can see that the RBA lowered the cash rate by around 4 percentage points to support the economy. But over the past 30 years or so, the cash rate target has trended downwards. This is a global trend affecting economies around the world. At the onset of the pandemic in February 2020, the level of the cash rate target was 0.75%, and by November 2020, the RBA had lowered it to 0.1%. This is the lowest ever level for the cash rate and very close to zero. At this point, there was not much room left for the RBA to move the cash rate. The governor and the deputy governor have both noted that the RBA board has no appetite to have a negative cash rate in Australia. But even with the cash rate at its lowest practical level, the board decided that monetary policy could do more to support the economy and help the RBA meet its objectives. So in response, the RBA has turned to other monetary policy tools. These tools allow the RBA to influence other important interest rates, aside from the cash rate, that are still higher than their lowest practical levels. They also help ensure banks are equipped to provide the lending needed to fund the economic recovery. Although we call these policy tools unconventional, they've always been part of the RBA's toolkit, and in fact, the RBA has used some of them before. We call them unconventional because, unlike the cash rate target, they have not traditionally taken a front seat in helping central banks achieve their monetary policy objectives. We can split these tools into two groups. One is asset purchases, and the other is providing long-term, low-cost funding to banks, which they can use to make loans. We don't have much time to discuss these policies in detail in this presentation, but if you want to know more, we have a series of video explainers on monetary policy on our YouTube page. The main takeaway is that these tools work through the same transmission channels as the low level for the cash rate. Together, they deliver lower borrowing rates for households, businesses, and governments. They contribute to a lower exchange rate than otherwise, and support the prices of some assets. This frees up cash flows for borrowers, supports the flow of credit to the economy, and provides confidence for households and businesses to consume and invest. So, have these monetary policy tools worked? This chart shows some variable interest rates faced by households and businesses when they borrow from the major banks. Over the past year or so, these interest rates have decreased, and as you can see, they are now the lowest they've been for many years. This will help to boost spending, employment, wages, and ultimately inflation to help the RBA achieve its objectives. Monetary policy is important, but before we finish, I also wanted to highlight that fiscal policy has played a very important role in helping the economy recover from COVID-19. This chart shows the government's cash balance as a share of GDP. It measures how much revenue the government has collected, mostly through taxes, less how much they've spent. If the government spends more than it collects, such that the bars are negative, it runs a deficit. The opposite is called a surplus. To the right of the line shown here are the government's budget forecasts for the next few years. The size and change in the government's cash balance is a simple way to measure the impact of fiscal policy on economic activity. Through the pandemic, the government provided extraordinary support for Australians' jobs and incomes, including through JobKeeper and additional social assistance payments. By August 2020, around 30% of the Australian workforce were receiving these or equivalent payments. Since then, the government has announced a range of other policy support measures, including in the budget that was released in May this year. More recently, both federal and state governments have also provided substantial support in response to recent lockdowns, including increased disaster relief payments, business support grants, and tax relief. Unsurprisingly, this has resulted in a large increase in the budget deficit. You can see just how large by comparing the recent bars to the smaller bars during the GFC. In line with the significant amount of fiscal support being provided to the economy, the government is expected to run large budget deficits, such that spending is more than taxation for some time. So to conclude, I just wanted to end with this chart. It shows some episodes where Australia's GDP has contracted over the past 50 years or so. I think it really sums up that the COVID-19 pandemic is the largest economic shock that most of our parents have experienced in their lifetimes to date. As we saw earlier, almost every economy in the world has been affected. This is just to emphasize that what you're studying is important, understanding this stuff is important, and even if you are studying this material in order to finish school, I encourage you to keep thinking and engaging on these issues going forward, perhaps even through further study and maybe even a career in economics. Thank you.
We're now joined by Luci Ellis, our Chief Economist, who's going to say a few words of encouragement for this cohort of 2021. But before we do that, I wanted to mention that Luci has come to us from a hearing before Parliament this morning on housing. And so I thought it would be a good idea, Luci, if you told the students in particular a bit about that, as well as how we think about the broader public policy landscape when our span of control is pretty much one thing, and that is monetary policy. That would be a helpful perspective from our Chief Economist.
Sure, thanks, Jackie. It did feel a little bit like Groundhog Day this morning, because it is not the first time I have been before Parliament to talk about housing affordability and housing prices. For many years, probably since the early 90s, there's been intense interest in the housing market in Australia. And essentially that has corresponded with periods of strong housing price growth that have outpaced income growth. And so what a lot of people have grappled with, including our politicians, is trying to understand why that is. And essentially there are two possible explanations that could both be right in some measure. One is that demand has increased, and the other is that supply is somehow restricted. The answer is both. And the thesis that I put to the politicians this morning is that it's over that broad sweep of many decades, it's mostly demand that's changed things, that there have been a number of reasons why people's demand for housing has increased over time relative to their incomes. And most of them boil down to increased capacity to pay, whether that's lower interest rates, making servicing a mortgage easier, servicing a mortgage of the same size easier. So then everyone goes and gets a bigger mortgage and tries to buy an even better house. Whether it's higher incomes, and so as living standards increase, less of your income goes to the basic necessities and there's more money left over for positional goods, which include housing. I mean, if you have more income, you might want to live in a nicer area or in a bigger, better house. And also just the availability of finance. So through a combination of disinflation, so we used to be a high inflation nation, now we're a low inflation nation, where we used to be a nation with very restrictive rules around mortgage finance that are now much more liberalised since the 80s and 90s. And all of those things have combined to make it easier for people to borrow more and therefore pay more for housing. And supply curves slope up. So there are natural restrictions and regulatory restrictions on supply. Part of the issue is that most of the housing is already there, and you can't just, if everyone's capacity to pay doubles over a short period of time, you can't just double the housing stock all of a sudden. The amount that's built in any one year is quite small, but there are also some regulatory constraints on that new housing, on that addition to supply, and all of those things make a difference. We talked, that's the broad sweep. And then more recently, there have been a number of things working in the other direction, including the apartment building boom of recent years, and the fact that with closed borders due to COVID, we've got slower population growth and therefore less demand for new additional housing. And those two things at the moment, there's actually quite a big wedge where there's sort of more, the growth in the housing stock is actually quite a bit higher than the growth in the population at present. So there are many different things going on, and helping navigate those complexities is one of the things I was trying to help the House of Reps committee I was appearing before with. But it is, there are many different complications around that. And of course, a lot of those complications are things that are outside the remit of the central bank. As Rachael has explained, we're here to think about financial stability and monetary policy. And while there are certainly financial stability angles to our concerns around the housing market, it's not really germane to our inflation target or our concern for lower, making sure that unemployment is low. What's actually going on? So we do have those concerns, but what we need to understand is that our remits and our relatively narrow set of tools are situated within a broader public policy framework. And we have to be mindful that there are other priorities beyond hitting the inflation target. Some of those are making sure that everybody has appropriate housing to their needs, that people can afford suitable housing for their needs, whether that is through home purchase or through rental. And so, this is a topic that will keep coming back. Thank you for your indulgence in giving that slightly extended explanation. I think that was probably the more structured answer I wish I'd actually given before Parliament. It's sometimes quite hard to give that more structured, when you've got questions being fired at you. But certainly, this will be a perennial topic, both of interest to the board and to the general public for quite some time. So with that in mind, I just maybe, Jackie, if I move to just speaking directly to the students for a moment, because I'm coming to you from Wongal land here in the Abbotsford office of the Reserve Bank, as in my home. We're all working from home, and I'm extremely aware of just how difficult it must be for so many students at the moment, doing online learning, facing the uncertainty of not being quite sure how things will play out, trying to do exams from home. It's been a hugely difficult year for you personally. While probably I think a lot of schools are better at online education this year than last year, having had some practice, you can't do your homework with your friends and, get the benefit of all of those conversations and, discussing some of the things that are going on in your homework or in some of those ideas. It's not so easy over Zoom. You're not having that interaction with people and that just break from study. And I'm very conscious this. My niece is actually doing her HSC this year down in Melbourne, and as she said to my sister, I will never have a school formal because in Melbourne, basically almost the entirety of last year and this year has been online learning for large chunks of that. And so those are those milestones that I'm very conscious people sort of wish they had. And that this is a very different year and a very different experience for this cohort of students in a way that that other people haven't had to experience. But it's also a hugely interesting and rewarding period in your in your life as someone who thinks about economics and human behaviour. And certainly it's been extreme. If it hadn't been such a terrible human tragedy with more than 4 million people dead, it is actually an extraordinarily interesting time and an extraordinarily challenging time to think about public policy. And so I just wanted to round off with some lessons that I've drawn over the last year or so. And the first is that economics is indeed about human behaviour, and that is what makes it so interesting. I mean, while a lot of it is very mathematical, in the tools that we use to derive our analysis, in the end, what we're doing is about people, and it's about the greater good and the welfare of people. And that, I think, is what retains its interest and the sense of purpose that you get from studying economics and being in economics, however you may choose to take your career forward. The second lesson I've drawn from the last little while, although it's certainly a lesson I was, again, very aware of, is that evidence really matters. And I think, there's nothing like a pandemic to have really drawn out how important it is to be quantitatively literate, to understand what you're being told in the media, to be able, who knew that the newspapers would be regularly, publishing things on a log scale? Now we all know how log scales work. I mean, that was not something that was part of common discourse 2 years ago. And thinking analytically about risks and relative risks and incentives yields surprising and valuable insights. And that's true both in economics and in public health. And, certainly talking with the people I know in sort of the health field and in public health, you realise that the economic analysis and economic insights of human behaviour turn out to be very valuable, and not necessarily insights that they have necessarily derived from their own studies. And the third lesson that I've drawn from the last couple of years, and again, one that has resonated with me throughout my career, is that everything connects and not everything is amenable to control. And so the trick is knowing what those connections are and what is actually outside your control and what is actually in your control and amenable to adjustment. Again, those are questions that people are not necessarily sort of alert to until an event like a pandemic comes upon you. But they're the sort of things that I think we can all learn from. And so I just want to give you all the encouragement that I can possibly give for your exam period. I hope this webinar has been helpful. And certainly I also commend to you the many resources, both the explicitly education labelled ones and some of the other things that we do that you might find helpful in your future journey, thinking about economics, human behaviour and the greater good. Thank you.